Hello, this is Professor Donna Byrne at William Mitchell College of Law, and this is an estate and gift tax online module. In this module, we'll be talking about gifts that take a long time to complete, such as checks and promissory notes and other kinds of things. So let's go. Okay, we've seen before already that a gift is complete if there has been a gratuitous transfer of property. That's the first thing. And the donor has so parted with dominion and control as to leave in him or her no power to change its disposition, whether for his or her own benefit or for the benefit of someone else. So the challenge now for us is to figure out when and if the donor has so parted with control. So in this presentation, we will focus on checks and some other kinds of transfers. And by the end of the module, you should be able to explain the relation-backed doctrine as it applies to gifts by check. You should be able to analyze a transfer in general to determine when the donor has parted with control. And you should be able to explain when a promissory note is a completed gift. And finally, you should be able to analyze employer-provided death benefits to determine whether there's a gift from the employee to the beneficiaries. Now, part of this will be in this video, and part of it will be in the next video. So, if I make a gift by check, when is it complete? Is it when I sign my name? Is it when I give the check to the donee? Is it when the donee cashes the check at a bank? Or is it when the check actually clears my bank? Okay, so remember, what we're looking for is when I've parted with control. But let's stop for just a moment. Why does it matter? We've alluded to the annual exclusion from the gift tax, which allows me to give $14,000 to each and every person I know each year, and it doesn't even count. So this is a January 1st through December 31st opportunity. We start over again on January 1st. So it matters which year these checks, these gifts fall into, because I don't want to be doubling up. All right, I want to try to space out these annual exclusion gifts if that's what I'm doing. All right, so we'll look at Albert F. Metzger, the Metzger versus Commissioner case. Now, Albert gave checks to some relatives, and the checks were delivered December 14th, 1985, so Merry Christmas or Happy Hanukkah or whatever. The recipients deposited them on December 31st. Okay, so we squeezed that in under the wire, still 1985. And then, of course, they didn't clear the bank until January 2nd. And that's 1986. So the checks were for $10,000 each, and at the time, that was the annual exclusion amount. So far, we don't have a problem. Doesn't really matter which year, but Albert made the same kind of gift again in December 1986. And those ones did clear in 1986. So that second round of checks, definitely 1986 gifts. So in other words, there were two sets that cleared in 1986. Only one of them can be sheltered by the annual exclusion, and that means that if everything belongs to 1986, we have some taxable gifts. It looks like Albert and his family were doing some estate planning. Sometimes when people get late in life and realize they have more money than they need, this is a way we can get money out of the estate. We give away a whole bunch of annual exclusion gifts every year. If we have a bunch of people, if I have 10 people to give them to, that's $140,000 I can get out of my estate with no gift tax, no estate tax. So it looks like that's what they were doing, but the timing kind of messed them up. So, all right, okay, this is just an aside. Notice that this is being handled by the estate of Albert Metzger. This is not an estate tax case. This issue came up during the audit of the estate. And so we really are focusing on the gift tax and whether or not these checks should be treated as 1985 or 1986. Okay, and there's our rule again, right? A gift is complete when the donor has parted with dominion and control and cannot affect the disposition. So when does that happen for a check? Well, we look at state law. And in Maryland, the law is that the delivery of a check is just conditional payment. It's not complete until it clears the bank. And so if that's the rule, then we have some taxable gifts and we may owe some gift tax. Fortunately, there is a relation back doctrine which says that if the checks were delivered and promptly presented for payment and duly paid, then the payment relates back to the date of delivery. So even though the gift isn't really complete until it clears the bank, we're going to pretend that it was complete when the checks were delivered, if everything went as it goes. So our question is, does this doctrine apply to gifts for the gift tax? Now, it was first recognized for charitable contributions. Charitable contributions, of course, are deductible under the income tax, and that's an annual tax, so we need to know which year the deduction belongs to. And then a later case applied the doctrine to the estate tax, and so that means so far we have the relation back doctrine for the income tax, we have it for the estate tax, and in this case the tax court thought it should apply to the gift tax as well. Taxpayers won in the tax court, but the IRS has said that no, non-charitable gifts are different. Well, it is different, the court says, when the donor dies before the checks are cashed. Okay, so can you see why that would be? We're worried about people kind of trying to get around the estate tax, and one way we could do it is to give our donees checks at the kind of late in life and say, hold on to this. Don't cash it now because I still need the money, but if I die, then cash it immediately, and it'll relate back to when I wrote the check. Yeah, that would be abuse. That would be abusive, trying to avoid taxes inappropriately. But Albert Metzger was alive when the checks were cashed. He lived another year, and so this case is different from one where the donees also do not deposit the checks in a timely manner. If we give the checks and then the donees hold on to them for a month and then deposit them, we wonder whether they had some secret agreement. That's not our situation. Here, the checks were timely deposited, right? December 14th to December 31st. Okay, it's 2 weeks. No, it's a week. No, it's a couple weeks. But it's the Christmas season. It's busy. You're getting all those Christmas cards. So this is good enough. They cleared right away. There was no issue with getting them paid. So the reason that it took till the next year was completely normal, right? Banks are closed on January 1st. I mean, they deposited them December 31st. It's not instant, especially when it's another bank. So in this case, the relation back doctrine applies. But it should be clear that the reason we need it is that the donor could have stopped payment up until they cleared the bank. So that's when it's actually technically completed. This is just a doctrine that says we can pretend that it was back then when you delivered the checks. And you'll notice in your casebook there's a little blurb from a revenue ruling that says IRS has agreed to follow this case. So for gift tax purposes, relation back applies. Okay, now we're going to stop here. In the next video, we'll talk about Bradford versus Commissioner and promissory notes. What is a promissory note? What is the effect of it? And we'll also talk a little bit about DeMarco with retirement benefits. In class, we'll do problems from this chapter, and we'll talk about the Burnett versus Guggenheim and Sanford versus Commissioner towards the end of the chapter. So I'll see you in class. Thank you for watching. These are camels.